U.S. stocks climbed to another record close on Tuesday, driven by the surge of artificial intelligence leader Nvidia, which surpassed Microsoft to become the most valuable public company. This milestone highlights the strong momentum in the tech sector and investor confidence in AI-driven growth. The broader market gains reflect continued enthusiasm and strategic rotations within the market. The S&P 500, Nasdaq Composite, and the Dow Jones saw gains, rising significantly, reflecting broader market sentiments. Meanwhile, Nvidia's market value has now reached $3 trillion, surpassing Microsoft, having already overtaken Apple. The stock surged 3.5% on Tuesday, continuing its 174% rise since the start of the year. Lastly, Qualcomm and Taiwan Semiconductor stock rose 2.2% and 1.4% respectively, while Micron Technology gained 3.8%. Now, these gains were supported by declining Treasury yields following a weaker than expected retail sales report. Let's get more on this now with the GTC Group's Chief Analyst, Jamil Ahmed, who joins me live from Dubai. Great to have you here with us on TRT World. How significant is Nvidia's rise for the AI sector, and what does the S&P 500 record close indicate?
In one word, it's relentless. The number of milestones that Nvidia has now achieved over the past 18 months, it's punching through ceiling after ceiling. Just to give you a few different examples here. At the end of 2022 to now, Nvidia's share price has increased by more than 900%. That is an incredible number. And during that rally, there's been so many different milestones. It was actually the end of Q1 last year that it rose to $1 trillion market cap, which was already dizzy heights. It was only 3 months ago that it actually surpassed $2 trillion, joining this magnificent 7 companies, mainstream names such as Meta, Google, Tesla, Apple, Microsoft. And now, as recently as this month, it hit $3 trillion US, which is now joins likes with Microsoft and Apple. And overnight, it's now become the major company in the world by market cap. And it seems to be set to stay on that pedestal because investors are all in on AI. A few different reasons here. AI is expected to contribute as much as 15 trillion to the global economy between the end of the decade, which means that the size of that sector could equate to the number of the Chinese economy if we look at GDP value. And overall for the S&P 500, the bizarre thing here actually is that Nvidia's rally has been so relentless that actually it's not yet included on the Dow Jones 30 industrial average, would be the 30 valuable US companies. That's how fast the rally has been. And when it comes to the S&P 500, naturally that also has a positive boost, but that's been supported as well by some return and optimism over US lower interest rates following some recent weakness in US economic data.
Jamil, what should investors watch for in consumer spending trends?
Ultimately, we have to watch US data, the reason being because the major component of the US GDP is actually consumer spending. So what we've seen overnight is there was a slight miss on the US retail sales, which signals some economic weakness for the second quarter. We have to remember here that the biggest elephant in the room, or the shadow that's looming over all of this, is continued uncertainty over when the Federal Reserve, which is the US central bank, might cut US interest rates. Weakness in US consumer spending does suggest some weakness as well in momentum for the second quarter. We've already seen the first quarter GDP reading was significantly below Q4 of last year and Q3. So definitely the signals are there that the US central bank can consider to lower interest rate policy later in 2024. But they do also need a helping hand from lower inflation numbers, where if you look at some of the peers like the European Central Bank, the Bank of England, they're enjoying more of a continued progress in lower inflation. But in the US, it seems to be somewhat of a plateau. If we use a diet analogy, we lost a lot of weight, but that weight is slowly coming back on. So we need more progress there in order to see more, I would say, indications of lower interest rate policy.